Hello there. Welcome to lecture 15, the final. This lecture is the final lecture of the model series. Don't worry, many more series will come. However, the day trading model has been explained as best as possible so far during this series. During this lecture, I will answer the majority of the questions that you were able to ask within the mentorship forum. Don't worry if your question did not get answered yet, because that means that your question has already been answered during a prior lecture of the model series. Let's dive into this lecture. First of all, I'm going to give you a risk disclaimer. Everything that I will share during this lecture is meant for educational and/or entertainment purposes only. I'm not a financial advisor. Nothing that gets published on TOTK, the ones that know.com, can be considered as financial advice or meant for financial investment decisions. Everything is meant for educational and/or entertainment purposes, and you have agreed upon this when you signed up for the mentorship. The first question that I would like to answer is the following. This user sent a very long message on the mentorship forum, and in my opinion, it was right away one of the most valuable questions that one could ask. I'm not going to read the whole message because it is of course very long. If you want to, please pause the lecture and you can read it for yourself. However, what the question was the following. The question said, how we could go about backtesting everything that has been taught so far within my mentorship. How can we objectify it? How can we collect real data on it that can't be interpreted in different manners? And I thought that question was very important to answer. So therefore, I'm going to answer this one as the first question. So first of all, when it comes to logging data, it's very important to note the following. When it comes to logging data, our main key or our main job to log is the following. We need to log where the market ran into, so where it repriced higher into, where it turned around. We need to log what was the reason why the market turned around, where it turned around. Why did a high form here and did we then deliver lower? And the same goes, of course, for the opposing side, where we're seeing the market drop lower into a price level, where we see a low form followed by an expansion higher away from that smart money reversal. Our main task is to identify how we can log this very specific price level. And what we can do first of all is we can log the exact low, for example, within this buy model right here. We can log the exact price level of the low. For the high, we can of course also log the exact high of the smart money reversal. This is one way of logging the reversal price. However, what we can also do is the following. We can define the point of interest. For example, we can utilize a higher time frame imbalance, a higher time frame breaker, a higher time frame mitigation block, whatever. That can be our point of interest for the market to draw towards and then turn around. What we need to do is simply log what was all present where the market turned around. And here comes another question then. What about implementing time into this logging? What about just making use of everything that is already visible on our charts, on our blank charts? Without any annotations, we can already make a few logs, such as the following. First of all, what we can do is we can log the 4 different market stages. We can log a consolidation, an expansion, a retracement, and a reversal. The reason why I'm bringing this up is because of the following. When we start logging our data, what we can pay attention to is the following. We can pay attention to how the previous time cycle has delivered. Let's say that we're currently looking at the New York session. During the New York session, what will we be looking at? We will be looking at how London delivered. So what we can do if we took a trade during the New York session, we can log how London delivered. For example, if London expanded, so that means we saw an expansion during London, we can say, okay, we saw an expansion during London. London made the market expand higher, for example. During the beginning of New York, we retraced and we bought the continuation that occurred then during New York. That's a way that you can log it, and there's no ambiguity about that. Either London expanded or it didn't, and you continued the trend during New York, or you didn't. So what you can do is the following. You can monitor the London delivery, the morning session delivery, and the afternoon session delivery. However, if you are a London trader, what would you then log? You would of course log how Asia delivered. So you would be paying attention to how Asia delivered and how London reacted of that. So what you're doing is every single time that you're trading, for example, a session, you look back at how the previous session delivered. And based on how the previous session delivered, you can log how that session delivered, and you can log how the current session delivered and how that influenced your idea. What you then can also do is say, well, okay, we know that time is fractal. We can basically fractalize time all the way down to smaller time cycles. We can also say, well, let's say that the first 90-minute cycle of the morning session consolidated. Let's say that the second 90-minute cycle then expanded higher. And let's say that the third 90-minute cycle of the day then reversed and basically expanded into the opposing direction of the expansion of the second 90-minute cycle, and also taking out the liquidity engineered during the first 90-minute cycle. What we can then do is say, okay, well, the first 90-minute cycle consolidated, the second cycle expanded, and the third cycle reversed. And during the third cycle, we took a trade in the opposing direction of the second 90-minute cycle. I hope that you're able to vocally visualize what I'm providing to you. And I'm testing right now whether or not you truly understand what I'm sharing with you. And I truly hope that you do. And please re-listen to what I just mentioned, because it's crucial when it comes to logging. What we can also log then is the following. Well, we know that we can log the exact price level at which the market reversed, and we can, for example, log if the market trades into a higher time frame PD array. But what we can also log is, okay, if let's say we took a trade during the third cycle of the morning session, during 10 to 11:30, what we can say is, okay, well, let's say we took a market maker buy model trade, and the market first of all traded below the low of the 8:30 to 10 time cycle low, and we see a Pershing liquidity occur. The higher time frame order flow is bullish, so we're anticipating the market to draw towards buy side liquidity next. Where's buy side liquidity resting? Above the 8:30 to 10 high. So what can we anticipate? We can anticipate a purge of the second morning cycle's low, followed by a reversal towards the previous cycle's high. That right there is again an objective way of logging data. For the afternoon session, it's exactly the same. If we see during the second 90-minute cycle of the afternoon session, the lunch low get taken out whilst we're anticipating higher prices, we can log the lunch low as our point of interest, where the point of interest is one of the most important reference points. Without a point of interest that gets reached during our time of interest, there's no idea. So something else that we can log is the following. We can log the exact reversal time, the exact high, for example, or the exact low. The reason why we want to be paying attention to this when logging our data is because if we get a large enough sample size, we can start noticing that reversals usually take place within certain time windows. And once we start seeing those time windows, it doesn't only give us confidence in the fact that our model will repeat, it will also give us the opportunity to say, I'm only going to look at the charts during these time windows because my data has shown to me that these are the time windows in which the chances of a reversal occurring are the highest. It makes sense then to only look at those time windows, doesn't it? Why would you be wasting time looking at different time windows than your data suggests you to look at? That's stupid in my opinion. So therefore logging the reversal times is very important. The next question that I would like to answer is the following, and that's a question about displacement. This user asked me what I deem as valid displacement. And to answer this question, what I've done is I've created a schematic to basically showcase to this user what I deem as real displacement. Here we can see a schematic of a market maker buy model, and by far the most easy way of recognizing displacement, as I've been teaching within this model series, is the following. It's a displacement when we see the following occur, where we see a crucial low get taken out within a market maker buy model, and we see the market trade into our point of interest. This is where our smart money reversal takes place. And we see the market displace higher. We see the market run higher aggressively, trading with speed and velocity above this high. However, it's important to note that the speed and velocity that you might see right here can also be rather lethargic, rather slow, and that tells you something about the delivery that's likely to follow. However, in the most ideal cases, we want to see speed and velocity above this high. And the reason why this high is important is not only because it is a bullish breaker, but it's also a high that formed inside of a CB right here on the left side of the curve. So the moment that price displaces above those price ranges, we have the following that takes place. We have an inversion value gap right here, a CB, that can be extended to the right, which can function as support on price. We have this high, which is a bullish breaker. This bullish breaker is the last upclose candle before this leg lower below this short-term low right here. And we have a BC that forms inside of this leg higher. And when all those things align, it's already a great sign of, okay, this is potentially the low risk buy within our market maker model. And from there on, every single leg higher, every single expansion higher, followed by retracement, is a next stage within this market maker model. And every single time that we expand to the upside and we displace above the left side of the curve, its respective retracement legs. Remember what I've been teaching you throughout this series. We want to see that new retracement leg that has been broken through function as support on price. Something else that I want to share with you is the following. When we take a look at ranges, we can understand that the previous cycle is not only important due to its respective high and low, but it's also important due to the price range between that high and low. And one of the things we can immediately annotate is 50% of the previous cycle's range, meaning equilibrium of that range. But there's more that we can apply there. We can, for example, apply quadrants within that range to establish what key price levels are. And if you would apply those quadrants between the previous cycle high and the previous cycle low, and also pay attention to equilibrium, you will see how the market will react off those levels if there is a real market maker model in play. And if you pay close attention to this chart and you just visualize or try to estimate where equilibrium is and where 75% of this range is, you can already see that 75% is around this price level right here, the price level of this high. Hey, what does that tell you? We break outside of the range and we trade back into it. And we don't only just trade back into it, we trade above the first quarter. And once that's established, that's a sign of CSD taking place. It's a sign of price trading back into the range of the previous cycle low to previous cycle high. That's something for you all to investigate. And it's of course the opposing for a market maker sell model. This is what the price range would look like. This whole gray box is the price range of the previous cycle. If we take a look at the market maker sell model, we can see the following. We can see that the market runs up higher, trading above the previous cycle high into a point of interest. This is where smart money reversal takes place. We then see price displace to the downside right here, displacing below this low. This low is so important because this low formed inside of this BC. What we can then anticipate is first of all that this BC should function as an inversion value gap on price. But what's even more important is the fact that we saw the market trade below this low, and simply the fact that the market trade below that low is already very significant, because if we were still in a buy program, that the low would have never gotten taken out if our point of interest is in fact where the smart money reversal is going to form or has formed. If we then see the market displace through that low with an imbalance, it's even better. What we can then anticipate is the market to retrace to then continue lower. Again, what I want you to investigate on your own is applying quadrants to the ranges of previous cycles. And if we would look at quadrants, we also need to look at equilibrium of the previous cycle's range, because equilibrium gives us everything we need to know when it comes to determining if the opposite side of the range, meaning the previous cycle high, got taken, and now we can determine whether or not the previous cycle low is likely to get taken out. The next question that we're going to answer is the following. Is the AMD character based on the current cycle or the previous cycle? And this question was asked by Moji on the mentorship forum. And this question is actually a very good question. And you might be wondering, why are these arrows here? Don't worry, I will show soon why those arrows are important. But this is a very good question because it's a very common question that I get asked when it comes to time cycles. And you need to understand that the current time cycle is always referring to one or two previous time cycles. Meaning in total we have 3 cycles that we are paying attention to, and it's always accumulation, manipulation, distribution. That's all we're looking for. We're only looking for the power of 3 consistently, and that's what makes the market go up or down. And our job is to recognize what stage the market is currently in, whether or not we're accumulating, whether or not we're manipulating, whether or not we're distributing. So in order to determine that, what we do is we go back into the past to see whether or not the previous cycle has given us clues for what we can anticipate for the next cycle. So if we then take a look at the schematic that I've been teaching you for a while now, it's the following. Where we have the current time cycle in which we're referring back to the previous time cycle, and during that previous time cycle we were referring back to the previous time cycle, so the cycle prior. And this, of course, gets best seen when we start paying attention to the exact timings. And we, for example, say, okay, let's say that this is the morning session that we're looking at. Then we have the first 90-minute cycle here, the second 90-minute cycle here, and the third 90-minute cycle here. What we're consistently doing is that we're looking back to the previous cycle, besides, of course, during this cycle, because there's no cycle to look back onto. Surely we can look back at the cycle of 5:30 to 7 a.m. and we can pay attention to the highs and lows of that cycle and the cycle prior, the cycle 4 to 5:30 a.m. However, what we need to understand is that technically speaking, a new AMD function has begun. However, this is very important to note right here. Simply because you have an ideal in your mind of how the market should deliver in terms of AMD, it doesn't mean that every single day at exactly 10 a.m. a distribution window begins, in which we're going to see one-sided delivery. Why not? Think about it logically speaking. Imagine if every single day at the exact same times the same stuff would happen. It would be too obvious, right? It would be like, oh, after a while, every single market participant would have realized that, oh, consistently at this time, this and this is occurring. So then it wouldn't be hard to figure out that it's actually being controlled, because else you can't make sense of that consistent movement at that exact time, besides a entity being in control of these markets. So what you need to understand is that sometimes, some days, the time cycles move, and therefore the AMD sequence also moves, where, for example, the accumulation window moves on to the next window, and that's something for you to look into. And that's why I'm personally a big fan of simply focusing on recognizing whether or not the reversals are taking place during our right times of interest. Times of interest is something we will discuss in a bit as well, relative to the previous cycle's liquidity. And if we have determined that, we can see whether or not the current time cycle is likely to deliver in a distribution manner, in a one-sided delivery profile. And if we can recognize that consistently, we can anticipate a move from point A to point B to occur. So to give a good answer to this question in as little sentence as possible, it would be the following. During the current cycle, we refer to the previous cycles, and the previous cycles, or these cycles here, set up the final cycle. So the current time cycle is setting up the next time cycle. And think about it that way. So based on the way that our cycle is currently delivering, the cycle that we're viewing price through, if it's consolidating, what can we anticipate next? We can anticipate manipulation. What can we anticipate after manipulation? Distribution, for example. The next question that I want to touch on is a question by Andy, and the question is as follows. Hey Susie, is there any criteria or condition to be valid origin consolidation of a market maker model and not just a normal consolidation? Of course there is. Else there is no objectivity behind your trading, and the question is always, what consolidation do I use? What is my target? What is the price level that I'm targeting? What am I aiming for? And It's something that I thought was already clear to everyone throughout this model series. However, that's why it's also good that I'm making this right here, this lecture, in which I'm asking questions. And this question is a question that, because this one person is asking it, I know that there are other people who are also asking this question. So therefore, I want to answer it as best as possible. Because what you need to understand is the following: the way that we are looking at the previous cycle's liquidity is the true way of determining what a draw on liquidity is and what a true original consolidation is. Because just imagine this. If, let's say, you're trading New York and you see the London low get taken out, whilst you're bullish, whilst you're anticipating higher prices, what's the next logical draw on liquidity? AKA, what is the next original consolidation within your market maker buy model? It's the London high, of course. But let's say that you're only trading the afternoon session, you don't have any idea of where the higher time frame is drawn towards, and you just see, okay, we've taken out the second 90-minute cycle of the afternoon session, the PM2 cycle, its respective high, and we have been moving higher all day. I'm seeing the signs that confirm to me that a high might be in, and therefore I'm going to look for a short. What are you going to target? Or what could you target? Because I'm not telling you to go out there and trade for yourself, as I outlined already during the risk disclaimer. What you could target is the following. You could target the previous cycle low, and that's your original consolidation. That's where the potential short setup, its respective entry, would be point A, and point B would be that previous cycle's low. And what we're doing there is we're making use of time-based ranges to make sure that we're objectifying our approach to the marketplace instead of just seeing, okay, here's the here did the market consolidate, consolidated there. You need to understand that consolidations occur all throughout the market, and therefore we need to find a way to basically discover what consolidations are real consolidations or what consolidations are real draws on liquidity. And that's where time cycles come in play, and that's where they can guide you into determining that. So objectifying original consolidations in a structured manner comes to the following. First of all, you can make use of time-based price ranges. Time-based price ranges being, of course, the PXH and PXL theory. But secondly, we can also look at price ranges, specifically advanced price ranges. Some of you are already like, oh, finally, he's going to discuss it during this final lecture, during lecture 15. Yes. All right, time-based price ranges. First of all, previous cycle high, previous cycle low. These two reference points are crucial, like outlined multiple times so far during this lecture. If you are not paying attention to the previous cycle's low and previous cycle's high, you are doing yourself a disservice because you're leaving crucial market data on the table right there. Previous cycle being not only the previous session's liquidity, but also the previous 90-minute cycle's liquidity, and even lower, for example, the 30-minute cycle's respective liquidity. If we would take a look at the price ranges that we would be looking at are the price ranges as I taught them within the advanced price ranges. And in the advanced price ranges, I outline to you the following. That's the following. When the market reaches, for example, the lower end of the range, what can we anticipate when we see the signs present that confirm to us that an SMR, smart money reversal, is in, when the higher time frame order flow is bullish? We can anticipate the market to draw towards the opposite side of the range. So every single liquidity pool that has been engineered in front of that buy side liquidity is a potential draw on liquidity. Next question I want to answer is a question that was asked by Brad within the mentorship forum. And the question was how we would go about swing trading based on the information that I shared so far. This is a very good question. Initially, my plan for the series was to also include some swing trading. However, I felt the past few months like swing trading was not the best thing to do. And therefore I stick to the day trading. And the reason why swing trading was not the best thing to do, because the higher time frame analysis, as I've been outlining within my weekly reviews, has been very precise. Let's first say that first of all, because if you've been following along, you would of course seen a great level of precision within my analysis. However, here comes the thing. Was the delivery clean? No, it was not, because intermarket relationship has been absolutely shit when it comes to looking at, for example, the index futures in correlation to the dollar. And because that is the case, what you see is that the probabilities of swing trading decrease significantly. And that's why we also saw some very nasty delivery profiles on the higher time frames. But a swing trading model will be shared one day. However, I still want to answer this question. So I'm going to basically share with you how one could transform the current model into more of a swing approach. And there's a very specific process that has to be applied, and all it has to do with is the timing aspect. Because in terms of price, the price side of things that I've been teaching you when it comes to market maker models, when it comes to entry patterns, when it comes to for example, confirming smart money reversals, etc., it's all the same. It's all fractal. It all occurs to one another. However, when it comes to the timing aspect, we need to look out for something. And that's the following. The day trading model is very precise when it comes to the time windows in which it's looking for specific things to occur within the delivery of price. With swing trading, this of course is a bit different since there aren't just, let's say, hour plus minutes that we're looking at. We're not just looking at the 24 hours of the day. Instead, we're looking at the full week or the full month or the full quarter or the full year. And because that is the case, we need to apply a different method of looking at time. And the way that we would then look at time is, first of all, different than the timing aspect and the times of interest provided during the series. What you should focus on instead is on, first of all, the overall sessions, their delivery relative to the daily delivery. So that means that if you're anticipating, let's say, higher prices for the index futures, and you are recognizing the signs of a potential classic buy day taking place, in which we're seeing the market open up, run lower from the midnight opening price, form the low of the day during London, and the market begins to expand higher. We can anticipate the beginning of New York to retrace, followed by an expansion higher. For example, we could then look to go long already during the London session, during the daily manipulation, or we can look to go long during the beginning of New York. And this is, for example, a very simple approach to getting into a swing trade when we know that the market is likely to be repriced higher for the remainder of the week. And if we understand that, what we could look for is we could look for example, weekly delivery profiles. And those weekly delivery profiles are also important when it comes to the monthly delivery profile. And if we understand that everything occurs to one another, but you just need to remove the timing aspect, try to look at it from that lens, try to recognize the higher time frame strong liquidity. The higher time frame not being, for example, determined based on a 15-minute chart or an hourly chart, but instead on a daily or weekly or monthly chart, and move from there. And then you will see that every single retracement that will take place on those higher time frames offers lower time frame opportunities, and those opportunities are potential entries. To finalize, I would suggest to focus on recognizing higher time frame POIs, SMTs in these POIs, followed by entry patterns. This right here is a very simple checklist when it comes to looking for market maker models on the higher time frames from a swing trading approach. When things clear up, and I'm anticipating them to clear up rather soon, I'm anticipating the markets to begin delivering cleaner the moment that we begin to see the index futures really just move again back in sync with the dollar, meaning completely doing the opposite of one another. The dollar is at a rather interesting place at the time of recording this lecture, and therefore we can anticipate rather big moves to come. And we need to mentally prepare ourselves for that as well. So when the time is right and we begin to see higher time frame setups become present instead of just lower time frame trading, I will seek to create a series solely about swing trading. It will of course not be as long as the day trading model, because from a nature perspective, I'm a day trader. My psychology is not suited for swing trading yet. And the reason why that is the case is because I'm, of course, a young man and I'm not comfortable with sitting in positions for a longer period of time. And that's also why you see me take simple low resistance liquidity runs. I get in and out of the market. I take surgical strikes. And that's what I find most fun as well. For some of you, that approach doesn't work. For some of you, you are way more interested in just buying 1 week and then just holding on to it for, let's say, a month or two. And that's totally fine. And it works. You can make a shit ton of money by doing so. However, what you need to understand is that you need to let go of the timing aspect when it comes to trying to capture, for example, the exact 30-minute interval in which the low of month is forming. Instead, try to focus on, for example, buying during the week that sets up the low of the month. So that's how you can change up the times when it comes to swing trading. Swing trading will be explained in the future series as mentioned. The next question I will answer is a question by Stefano. And this question is a very good question. And the question goes as follows. He mentioned that for high probability setups, we need SMT to be placed in a reversal. However, what about the price levels where reversals are occurring? We, of course, now know the advanced way of looking at ranges. Would it mean that if the market would reverse prior to, let's say, a range low at 0 or a range high at 100, that it is low probability? By itself, no. And let me explain. Because there are levels within that range that are important, such as the 25% level, the 50% level, and the 75% level. And you need to understand that within that range, from 0 to 25%, there are again ranges that can be plotted. And between 25 to 50, there are also ranges that can be plotted. And every single time that the market reaches, for example, a range low within that larger range, we can anticipate that we are likely to see a continuation occur higher if we're anticipating higher prices, for example. So to answer this question, hell yes, you absolutely want to start paying attention to those price levels. And that's also why I begin this lecture with answering how we could objectively log the data, how we could objectively pay attention to when the price level gets reached and what price level exactly gets reached, what the exact turning point is. And by consistently doing so, by consistently paying attention to that, you will see that it's in fact the price range that matters. Here we can see a visual representation of what I just explained. Notice that these numbers can be adjusted, and this is simply a rather basic explanation of a range where we have 0% of the range and 100% of the range. At the top of the range, we would look for shorts, and at the bottom of the range, we would look for longs. And the final question for this lecture is as follows. It's a question by Bryson, and the question is, Zusi, when are you going to touch on price cycles? The reason why he's asking this question is because in the mentorship forum, I created a topic or a channel where specific topics can get discussed, and every single channel has its own topic name. And it was this one channel that has been created, and it's called Price Cycles. And what I would like to share with this user and everyone that made it this far to the end of this lecture is the following. Everything I've been teaching you within this model series has to do with price cycles. Everything. We have time cycles and we have price cycles. And no one yet has come to the realization of what they exactly are. And I'm simply going to wait and wait until someone recognizes what I literally hid in plain sight. And what I hid in plain sight is simply a sequence of events that we're looking for every single day within every single setup it's repeating. And it has to do with time and price. This occurs, this occurs, this occurs, this occurs, this occurs. That right there is a price cycle. And I'm looking forward to seeing whether or not you'll be able to determine what the exact price cycle is that we're looking for. The topic of price cycles is something that I will discuss more in depth, whilst you of course have the opportunity to watch over my shoulder during the next series. And this will be a very important series because it will show you how I personally internalize price action, and I will not hold back on anything. Surely there are some things that I won't teach and I won't discuss, and that's what I mentioned from the beginning of my whole mentorship. However, when it comes to the things that I'm willing to teach. I'm not going to hold back, and you're going to exactly see and learn how I view price. Within this model series, you already got the opportunity to do so, and you already leveled up your understanding of price action significantly based on both time as price. However, we're going to take it to the next step with this new series. The new series is called Juicy Uncensored, and you can anticipate it to begin as soon as possible, as soon as I open up the charts and I begin to see signs within the markets that allow me to engage or disengage. With that, this lecture comes to an end. With that, the model series comes to an end. This is the first series that I've ever done for my mentorship, and the feedback has been insanely positive. I want to thank you for watching this lecture. I wish you all the best, and I look forward to speaking to you during the next series called Juicy Uncensored.